Ladies and gentlemen, good day and welcome to Macfos FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ramadin Rane from HIM Securities Limited. Thank you, and over to you.
Thank you, Yashasvi. A very warm good evening, ladies and gentlemen. Thank you for joining the Macfos Ltd FY24 earnings call. Joining us on the call today from the management team are Mr. Atul, Chairman and Managing Director, Mr. Vinod Prasad, Full-Time Director and CFO, Mr. Nilesh, Full-Time Director of Macfos Ltd. We will commence the call with the opening thoughts from the management, post which we will open the forum for Q&A session, wherein the management will be glad to respond to any queries that you might have. Before we get on the main call, I would like to read the standard disclaimer. There may be forward-looking statements about the company and the subsidiaries which are based on the beliefs, opinions, and expectations of the company's management, as on the date of this call. The company does not assume any obligation to update their forward-looking statements if those beliefs, opinions, expectations, or other circumstances could change. These statements are not guarantee of future performance and involve risks and uncertainties that are difficult to predict. Consequently, participants should not place any undue reliance on such forward-looking statements. With this, I will hand over the call to Mr. Atul to take it forward. Over to you, Atulji. Thank you.
Thank you, Raneji. Hello, everyone, and thank you for taking out your time to join this call with us today. First of all, I'd like to welcome everyone here. I always say that our shareholders are our core partners, so I welcome all our partners here for this very important call of the year. We are very happy to present our FY24 financial results, which showed a very robust performance. During last year, we have achieved roughly a revenue of 126 CR with EBITDA margin of roughly 17 CR and PAT margin of roughly 11 CR, which is a very good growth compared it to a year earlier, with a 56% year in revenue, a 47% increase in EBITDA and PAT. We believe that the fundamentals are very strong, and we also believe that there will be growing demand for these electronic products in coming future, and the future overall looks really optimistic, and we are optimistic that we will continue our current growth trends even in the future. Last year's call, we spoke a little bit about semiconductor shortages and logistic delays, but I think those things are now things of the past. So right now there are no semiconductor delays, semiconductor shortages and logistic delays. We have also worked well in the last year to strengthen our relationships with our suppliers and optimize our business with them. This gives us better control over procurement cost as well as lead time. We have also been spending a lot of time and effort to do our expense management well, because we know that maintaining our operational efficiency is really crucial for our business. Furthermore, if you see, our key business matrices such as our visitors, both app, website and app, total orders that we have served, then average order value, number of repeat customers, all these key business matrices, they continue to show a very good positive growth. We are also putting a lot of effort, continuous effort in enhancing our inventory management capabilities. As we know that our inventory is both, it's a great asset to us, as well as if not managed well, it becomes a threat to our business. As highlighted in our previous communications, our outlook for next year, that is FY25, is really highly optimistic, and we are pinning that on two key strategies, which hereafter we'll be calling Robo 1.0 and Robo 2.0. I'd like to spend some time understanding what these two strategies are. So basically, Robo 1.0 is our current electronic distribution business, and we want to keep it going. And it's really simple for us. We know how this business is done. Basically, there is a ABCD to grow this business. Like A is adding the new product, B is having better in-house IT infrastructure, better software. C is having efficient supply chain, and D is having a great customer support. So new products, in-house IT infrastructure, efficient supply chain, and great customer support. When we maintain these things, Robo 1.0 will sustainably grow for long future. Now, what is Robo 2.0? So Robo 2.0 is centered around our own products. So as all of you might be knowing already, we also develop some of the products in India, and some of them are OEM products. So these products will give them a separate focus, so that in coming 5 to 10 years, these will grow rapidly, and our brands and our products gives us higher margin, higher competitive edge. So Robo 1.0 is for our current business, and Robo 2.0 is looking into future and strengthening our position with our own products and growing them. It's just like planting the seed, and we are planting the seed today. Robo 2.0, keep giving it a separate focus, dedication, though that business is not very big for us today. And we are very sure that 5 years, 10 years down the line, when we look back, it will be out. So Robo 2.0 will be roughly centered around Smart Elect brand of products, which are electronic sensors and modules, Easy Make brand of products, which are mechanical products. Then we already have registered 2 trademarks, Simplify and Wildcraft, for our drone-related products. And our OEM products will be under the brand name of Storage. We already have these lines set up since last 2-3 years. We have been developing products a bit by bit. However, this year onwards, we will be putting in dedicated efforts, and will be taking this all into one umbrella of Robo 2.0. This will also give our team clarity and focus, which is required for future growth of these products. I think that is it from the management side this year. I'll be very happy answering all and any of your questions. And thanks again for being here with us for this call. Looking forward to your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Rohit Polti, an individual investor. Please go ahead.
Thank you for the opportunity and great set of numbers. So two, three questions from my end. So first question is on this BIS in general. So what's happening in other industries at least is that the government is sort of creating non-tariff barrier by mandating BIS certification for certain products imported from outside. So they range from certain electronic items to even footwear, etc. So if given we import a lot of our supplies, as you mentioned in the past, do you see this BIS hallmark as a risk to procurement for us? Basically, if the BIS hallmark is not there, you're not allowed to procure them from the country. So is that a risk at all for procurement of our supplies?
Thank you, Rohit, for your question. BIS is basically Bureau of Indian Standards, and as far as I am aware, it is required for some of our products like lithium batteries. However, it's just a certification. Like it says that if you have BIS certification, let's say for example for battery, then the battery is safe for use for Indian customers. We have been doing BIS certification for some of our batteries since last 4 or 5 years. And as long as I see, it's not a challenge. Yes, this government is expanding BIS certification to some other products as well. However, in our scenario, I don't see it as a roadblock. It increases certification cost per se for a particular product, but other than that, it does not create any roadblock for import or anything.
So in your conversation with suppliers from abroad, like let's say China or anything, do you see them saying that, the government mandating BIS certification for the factories or the companies from where you source supplies from, do you see some sort of noise like that happening?
It's been there is no recent change as far as I know. It's been there since long, as I said, BIS certification requirement for some products. And in our case, whenever we know that for particular product BIS certification is required and we talk to suppliers, we have some, because we have either supplier is going to put in some money or we are going to put in some money for the certification. And then there are maybe some arrangements where it is ensured that we will recover our money if we are putting in. If supplier is putting in, it's okay. So maybe we'll ask them to provide the material, maybe to us, give us a sole distributorship for India or something like that. And then there will be some minimum volumes we need to drive to cover the cost we incur in BIS. But yes, there is no, when we talk to supplier, there is no hue and cry about BIS. It's just a matter of without BIS, you can even order smaller quantities. But when the BIS comes into picture, you at least have to have a certain volume so that the certification cost makes sense. I think that's the only thing. So it affects more of a smaller player, and it also gives a good business opportunity, because even some of the individual customers who want to buy that product, they cannot buy without BIS certification. They want to import internationally somehow. They cannot do it without BIS certification. And if we have the certification, we have the message. So it's not a threat. That is what I make from your question. But it's a balance of a little bit challenge and a little bit opportunity.
Understood. My second question is on working capital. So over the last 3-4 years since 2020, our corporate customer base has been increasing rapidly.
Yes.
And from my understanding, to our retail customers, we take cash in advance or on when the time the order is placed. So there is no receivable cycle. But when we sell to corporates, there is a certain amount of time before which we ask them to pay. In that context, do you see our working capital cycle on average increase over time? Because I believe your B2B business will grow faster than the retail business. So if you could comment on that.
Yes. So there are two things we need to understand when it comes to B2B customer compared to retail customers. So when we are doing the retail customer, we have the material in stock, and then we receive orders, and then we dispatch it to the retail customers. But the payment is always coming in advance. While in B2B customer, as you have rightly pointed out, that we have to provide some credit terms. Of course, we are very, we are not very, we are a little strict on those terms. That is one thing. But on the other side, many times to corporate customers, we have back-to-back orders. Like we take some advance. Against that advance, we order some material from our suppliers. So we don't have to keep a lot of inventory. So they are inventory light due to the orders. But on the other side, we have to provide some credit terms for higher sales. So it balances out the total cash flow proposition. Like for general customers, like for the B2C customers, we have to stock in the material and then we wait for 1, 2, 3 months, we wait for the orders. While in case of B2B customers, mostly we get the order and the material comes and we dispatch it right away. So it balances out in both things. And generally, our as a rule of thumb, as a policy in the company, we always want to keep our debtors divided by our creditors less than 1. So we do not want to have total debtors more than what we can get credit terms from our suppliers. We are a bit restrictive on both sides to maintain the cash flow.
Perfect. That was helpful. And my last question, because I couldn't attend the EGM, could you detail the use for the 25 crore preferential, the capital that you raised? I mean, how do you intend to use it? By when do you intend to use it? And generally around those, that will be helpful to hear.
Yeah, so our view on that capital is very simple, that since now our business is growing and overall electronics market is expanding in India, so we will use those funds for 2 things primarily. One is to add new products aggressively, to have newer SKUs in our portfolio. And second thing is to solidify our position in the market. So maybe increasing the supply chain efficiency by maybe just by 1 or 2%, something like that, by putting in some extra stocks here and there. So overall, one is to have higher SKUs in our portfolio, and second is to solidify our position in the market. And we have, by then, we do not have a very strict deadline for this, but we do not intend to do anything haphazard. So our only guideline to use up that fund is we don't change anything in our current wage and means processes unless we feel that it's with the same efficiency. So we want to maintain the same efficiency. पैसा आया तो उसको गलत तरीके से यूज नहीं करेंगे, तो वो अकाउंट पे थोड़ा ज़्यादा दिनों तक रहा तो चलेगा. However, it has to be used with the same efficiency. That is the bottom line for us.
So when you say efficiency, you mean the inventory rotation, right?
Yes, it's primarily inventory rotation.
Understood. That's it from me. Thank you. As always, this call has been very helpful. Thank you.
Thank you, Ravi.
Thank you. We'll take a next question from the line of Sumit Poddar from Tikona Capital. Please go ahead.
Yeah, hi sir. Great year. Congratulations for those numbers. First, if I can, while you alluded to the fact of Robo 2.0, if you could throw some more light, while we have mentioned a bit about the products, but maybe if you could throw some more light on the market size or the opportunity, and within that, how you're planning to capture that, and what kind of investments that would be entailed in terms of CAPEX as well as OPEX to really capture that Robo 2.0.
Okay. Thank you, Sumit. Basically, when we are talking about Robo 2.0, we already talk about electronic part list, EasyMech, 2 brands for drone and Pro range. Now, you mentioned about market size. So I'll not go into numbers, but we all know that overall electronic sensors and modules, drone related activities, or some tools and measuring instruments, these are the hot, because we have all the data. We are seeing a lot of categories. We know these categories are hot categories in our segment. And what we believe is we have a certain edge in certain areas. Suppose we are talking about smart elect. either there are sensors and modules made in China which are cheap but the quality is really bad, or you have something made in European or American market which is a good quality, cheap prices. So we believe that we have an opportunity in between where we can make good quality products at a reasonable price. So that is where we want to grow the smart index brand. Similarly, we have figured out opportunities in these 4 categories, and because this call can be attended by anyone, I don't want to go very much into details of those, but that is the thought process behind that. Like drone segment, who doesn't know that drone segment is doing well in India from last 3-4 years, and having made in India products in drone segment will certainly give us some edge 5 years down the line. That is like a very obvious thing for us being in the same business for more than a decade.
Understood.
As long as the investment goes, we as a Robo are very frugal people. So for last 3-4 years, we have been doing these activities in bits and pieces. We have already seen some traction into these categories where we are building the products, and we want to grow organically. We are not in any hurry to set up some drone assembly line in coming 2 years. We want to launch some products, see how much traction is there, and organically grow. So the belief is these things has to be profitable. It does not mean we are aggressive. That means that maybe instead of launching 5 products a year, we can think of doubling our team size and work on 10 products. However, those products have to make financial sense. They have to be profitable.
Right.
So
any specific,
we will get them, maybe in some cases we'll have some manufacturing activities like some sub-assemblies or some getting them done from outside if it is financially more viable. And in the due course of time, we'll do what is necessary, the scale of the manufacturing and the cost that we are offering. So right now there is no plan on spending these on capex.
And these new products that we are talking about, I mean, these are any number that we have outlined in terms of capex, or will it be like we'll invest as it comes?
We'll invest as it comes, but as far as we see, there is no huge capex required. I mean, there will be some. We have already increased our team sizes to these development activities, which are like 6 to 8 people last year, which is currently 20-24 people. However, more efforts will go into the R&D, like design and development of these products.
Okay.
And the machines and the capex requirement comes when you already have certain volumes with you, which is going into the market. Till that point, we can get the products, assembly doing here and some partially manufacturing from multiple sources, so that we can be light on these capex requirements.
And these products, I mean, they are well tested in terms of, I mean, with the customers in terms of opportunity, or is it that we are trying something new that will open up new markets for us?
I really don't get your question.
So, I mean, whenever any innovation really comes up in any of the areas, many times as a manufacturer, as a innovator, we think that, okay, this will really work well. And it may not necessarily work the way we think, right? So in terms of market acceptability, whether the new products or new areas of investment that we are thinking of, is it that we are kind of having already some acceptability by the clients, or is it that we are kind of trying based on our experiences?
Yeah, I understood your question now. So basically, we are not doing any research and development which nobody has ever made in the world. So these products, as I explained about smart index modules, so they're basically these modules have been made by some Chinese suppliers, but the quality is not so good. Price is very cheap.
Right.
Made by some European people, but there is a high price, and then there is good quality. And we believe that we have an edge. We can make it at a lower cost than European, but better quality than Chinese. So thankfully, Robi's business model says that everything comes from the sales perspective, that If it can be sold, only then we go into the making our own products. We are not making something new out of the world. Yeah, that is not what we are doing.
I think you made a point clear. I mean, if it is already being manufactured and being sold, it's just that we have to match the price points which make sense for the client. So, yeah, I got a point as such.
Yeah, something like that. And along with that, we'll have certain things which will be changed in the product. We'll add our flavors, like adding some features, removing some features, because we know customer feedback. We know what customer wants, what they don't want.
And sir, in FY24, I mean, if you could throw some light as far as growth in corporate sector versus retail sector, and within that, if you could throw some light on what are the good or very large corporate clients that we might have added. If not the names, of course, I mean, sectoral or a broader brush would be helpful.
Yeah, so as a rule of thumb, we have decided not to give the combined numbers hereafter. And that is the only reason for that is we see the overall revenue or overall growth of the company as one, because of course we do B2C customers, then they grow and then they convert to corporate customers, so it's a one chain for us. But if I just have to give the numbers compared to last year, I think our corporate sales was around 53-54% during last financial year, FY23, which has grown to 57-58% FY24. And about corporate customers, I don't think it will be right to give a few names, because as we said, even our biggest corporate customer is not very big. It's not like that we are just manufacturing 1-2 products for Tata, Mahindra, like we have thousands of even the corporate customers. So I think there is no one customer which is billing us tremendously. We have a lot of corporate customers. But yes,
within broadly 60 crores or 60-65 crores, what would be the size of the biggest customers? A broad number. I'm not wanting an exact number, but this is just to get a direction rather than any specific numbers. Or
the biggest customer will be somewhere around 1 crore.
Sorry, I didn't catch that, sir.
Yeah, so biggest customer will be somewhere around 1 to 1.5 crore annual business.
Okay. So, that again, as you said, it implies at least 50 to 100 or maybe even thousands of more than 100-200 customers that we already have as such.
It may be the biggest customer. It goes on reducing as a trend. So there are other customers. If I have to give you a number, it will change the rate to 10,000.
Understood.
And this is our strength, as we say, because eventually we believe that the order values and everything will grow, and these distributed customers give us the support. Even if you go away, you will always add up. And as an industry, electronics is growing. So we believe that this is kind of safe for us. We are not dependent on one single customer.
And Chief, in terms of margins, if I margins have declined compared to last year. And even within that, there is some seasonality in H1 versus H2. If you could throw some light on that, and given that we are investing going forward, how should one look at the overall trajectory? Whether it would kind of, because of the investments, we would have a bit of a lower margin than then growing up, or what is the trajectory basically? So first, of course, what really happened of margins in FY24 versus FY23, and within that seasonality of H2, and the trajectory.
Yeah. So if we talk about the margins of FY23 against FY24, they have gone slightly down. But I think that is, we always keep this margin bracket of 8 to 10%. And I think we are, even in this year, it is around 8.57%. So we are well within that bracket. And the rest are, we are now, even in future, we will be maintaining this 8 to 10% bracket. Year on year, I think we, rather than just looking at margin, there are 3 factors. One is margin. Second is acquiring more of the market share. Third is maybe solidifying your positions into some categories where you want to go aggressive and then maybe sacrifice margin for 1 year or something like that. There are some strategic decisions to those. But yes, we are confident that this 8 to 10% bracket that we have been saying from day one, we will maintain our margins into that bracket for longer runs, and we'll take all the efforts. And if there is, like right now, at this point, there is no change in our strategy. We want to be acquiring more market share, solidifying our position with maintaining 8 to 10% margins.
But sir, that is the net margin level, right? I mean, of course, given the size, there is some gross margin benefit that investments that you are doing. Similarly, operating leverage that is there. And ultimately, if you're saying net margins are going to stay the same, I mean, how should we then look at it given the fact that there are multiple margin levels for you? So would that all get invested going forward? And then if that is so, then for how long? That is the question.
I really didn't get your question.
No, so Chief, I mean, given the fact that you are coming out with your own products, and that would definitely have much higher gross margin, right? Because you would be able to get more pricing power as well as the IP that you would add that would give you a higher gross margins. Gross margins in terms of the sales minus the raw material itself, right? Because you've invested your IP. And given the fact that we are just 123 crores, possibly over a period of time, the scale itself would also give you an operating leverage where the fixed cost over the variable cost is getting recovered over a larger part of revenue, right? So all these two benefits over a period of time should flow down to the net margins. And if the net margins are going to remain the same, how should we look at the benefits of the investments that you are doing as well as the operating leverage that will kind of flow in?
Yes. So I understood your question now. So basically what we are thinking at this point in time is, see, our margins will always have tendency to reduce for certain products where there will be increase in competition, or as we said, that corporate clients will always want more discount or corporate sales is increasing. However, we want to maintain our net margin in the bracket of 8 to 10%. And having a long-term view, making our own products, establishing our own brands, that gives us that leverage in coming 5 or 10 years, slowly but gradually increasing those sales to maintain those margins in that bracket. So it's a very complex dynamics, as we say, about the margins. You just can't look at one thing and you just can't look at second thing. As on today, our services and our own products business stays somewhere around 8 to 10% of the total revenue. And as this grows, this will give us higher margin, just to simplify the things. On the other side, the competition as the size and the corporate client, they will have a tendency to reduce our margin slightly. Of course, it will never be always reducing trend. It will come somewhere where it will plateau on something. But our efforts for next 5 to 10 years with this Robo 2.0 are focused on building our own brands and building our own products, keeping in mind these margin dynamics as well. So you have a higher control and you have higher margins. That's the best part about Robo 2.0. But we do not want to put any numbers to it right now. It's just a baby. It just has started going. So what we want to do is put in more focus, have bigger teams, let those products organically go into our store, go into our customers' hand, let them experience that. We will also learn, and eventually it will grow. It started with 2% like 3-4 years ago. So we are there at 10% right now. Without that, I'm pretty sure our margins would have even dropped below what they are today. But that is where we know certain things will come. We are not afraid of admitting it, and we are already thinking in future and taking actions today because it will not happen overnight. So that is how we are thinking about this margin thing and Robo 1.2 and 2.2.
Understood. So that was quite helpful. I have a few more questions, but I'll come back in queue because others might want to have a question. Great, sir. Wish you all the best, and I'll come back in queue.
Yeah. Thank you so much.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We'll take a next question from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Good evening, sir. Thank you so much for taking my question. Firstly, congratulations on a great set of results, sir. Hope I'm audible.
Yes, this is your audible.
Yeah. So my first question, sir, what kind of growth are we planning in terms of revenue guidance for FY25-26? Currently, you've grown fantastically at around 40%, 50%. So will that trajectory continue for the next 2 years, sir?
Yeah, about growth forecast, we have, I just don't want to put a number to it, but yes, we are pretty confident that we will grow, we'll continue our historical performance.
Okay. Fair enough, sir. And sir, just wanted to understand in terms of inventory risk for our increase now segregated into Robo 1.0 and 2.0. So what kind of inventory risk do we carry if if we are importing the product? So how much it comes on our balance sheet, and then how much type of inventory risk for that, in case if it's not moving, that we have to keep it with ourselves. So, what kind of that would be for Robo 1.0, and for Robo 2.0, we would be, manufacturing some parts ourselves, some parts for a third party. So what kind of a inventory risk do you foresee in that, sir?
Yeah, so first you have to understand, I'll take this Robo 1.0, 2.0 thing out of this question. So Robo 2.0 do not get any free goodies. We are not going to give any unnecessary advantage to Robo 2.0. Like, we're not going to sacrifice any unnecessary things that we are maintaining, like inventory, or just jump into it and have a big investment, something like that. They will grow organically, and the inventory principles are same for Robo 1.0 and 2.0. So there will be no accumulation of excess inventory for Robo 2.0. Yes, it might happen that making OEM or making manufacturing the product, there will be some minimum requirement, but the same goes with even our regular electronic distribution, that to make the imports of the product cost effective, we have certain volume requirements. So I don't see any change. It's not going to change anything in our inventory. And inventory, as I always say, inventory is both two-sided sword for us. So one side, it's a really great asset. It drives good business. On the other side, if not managed well, it is a threat to our business or risk to our business. And what we have done well in last 10 years is we have developed our own inventory management system, and we always keep our inventory in check. We are very, our softwares take care of that right now. If you look at the numbers in our presentation, financial year 23-24, we just have 52 lakhs worth of inventory, which is slow-moving inventory, more than 9 months. And last year it was somewhere around 22 lakhs. So I think it is, sorry, I just missed the number. So it is 3.68% of the inventory this year. Last year it was 2.33%. So it's just a small rise, which is expected with this kind of business and the strategy change. Remember, this is not a dead inventory. We'll still sell these products, but we have a check on our inventory. So I don't think that's a point of concern right now.
Oh, okay. So that makes sense, sir. And sir, just with regards to our own products, could you just, maybe detail? So will we be setting up our own factory type, or will we be getting it majorly from third party? How would that flow, sir?
Yeah, so the products are designed and developed by us right now. I'll give you a small example. If I'm making, let's say, a small mechanical accessory, a mounting bracket for motor, what I need some laser cutting for the bracket, then CNC welding, then some welding, and then maybe some anodizing or surface coating. But I do not, because if I have to put in those setups, that's some crores of cost. And why would I do that if I can just pay a little premium on those activities and get it done from outside? Those are still designed and developed by us. However, these activities, I'll get it done from outside. On the other hand, for some of the Smart Alex products, the assembly setup, the assembly machine that required was very small, like 6 to 10 lakh rupees of the investment. That we have already established in our office, because we have more than 200 of smart elect products now, and it was a hassle to take the products, go to some assembly guy, get them assembled, again come back, because every day there will be some product which we need to assemble. So now we have a small electronic assembly setup in our own office, and we are doing it in-house. 2 years ago, we are not doing it, because 2 years ago, maybe we were having just 30, 40 products, and it was more economical to do it outside. So these products that we are doing, our main focus is, creating our own products and generating sales with higher margins and with our own brand protection. About manufacturing, it's just pure economics. Whenever it becomes more economical to do it in-house, we'll do that. Otherwise, we will never do it.
Okay. Perfect, sir. That, helps me a lot, sir. And there is one final question, sir. With currently, we are in a lot of sunrise sectors, but do you see any kind of risk, like maybe from competition or any regulatory or, something along those lines, any kind of a broad-based risk that you see that, that can hamper our growth, sir?
Competition-wise, I do not see any huge competition to us. Of course, since we are a listed company now, and since the segment is growing fast, there will be people entering in this segment. There will be competition mushrooming in, mushrooming out. That will happen. That is happening even today. But I don't see any company or anything which we can call a threat right now. And the most important thing is we know this will happen. We know this since last year. That's why we are very adamant on our supply chain optimization, our ERP development to increase our efficiency. As we have already publicly announced, we have already set up a company in Hong Kong. We have already a warehouse in China. So we are trying to optimize these things so that whenever competition emerges, we have a first mover advantage. We'll move ahead and we'll establish the prices, or we'll establish the efficiencies, so that the competition will find it really difficult to compete with us. Again, Robo 2.0 or our own product is a part of that as well. And second threat, of course, India, China, geopolitical threat, China, US, that is there, but we really don't think much about it. It's just out of our control, and it is as it is. So whatever it is, you already know what it is.
Oh, perfect. So that helps me a lot, sir. Congratulations on a good set of numbers and all the best, sir. Thank you.
Yeah, thank you, Dashiji.
Thank you. Before we take the next question, we'd like to remind participants to press star and 1 to ask a question. The next question is from the line of Karan Sanwal from Niveshaay. Please go ahead.
Yeah, am I audible?
Yes, Karanji, you're audible.
Handset
yeah. Hello, is this better?
Can you use your hand? Okay, please go ahead.
Yeah, thank you so much for the opportunity, and congratulations on good set of numbers. So I want to understand, what is the current warehouse capacity, so that, so if you would require any expansion for the same in the near term?
Okay, so currently we are processing, we have 3 times the warehouse capacity. That means if we are processing X order today, we already have the space and system set up for 3X capacity. And over the period of time, we have learned that we have to keep it this way, that we keep on making sure that our warehouse systems and the space both are good enough for what orders we are processing, as well as at least some future growth.
Okay, understood. And what would be the spend on advertising, marketing, branding for the current year? As an absolute amount or as a percentage of revenue?
Karan, your voice is muffled. Can you use your handset mode, please?
Just a minute. Hello?
Yeah, Karanji. I got your question. I'll just answer your question to save time. So you asked that what is the percentage of your marketing, percentage of total revenue or something like that.
Yeah.
I do not have the number ready with me right now, but as we always say, our marketing expenses are capped at 5%, like not more than 5% of our online sales. And as far as I remember, they were somewhere around 4%, 4.5% of our online sales. And our online sales are less than 50% right now. So overall, if I have to give you a number, it will be around 2% to 2.5%, somewhere between that. Is it good enough?
Yeah, that helps. Also, when we say the online and offline business, I'm assuming it's the bifurcation between B2C and B2B.
The bifurcation is?
Between the B2C and B2B business?
B2B and B2C business.
Understood. And also one last question, like we have seen an increase in our short-term loans and advances. So are these majorly the advances paid to the supplier for the current year?
Could you repeat your question? Your voice is actually noisy.
So there has been an increase in short-term loans and advances for the current year. So wanted to understand like what does constitute to those short-term loans and advances.
Yeah, I'll just hand over to Vinod for this question.
Yeah.
This is Vinod online. So short-term loan and advances, this is advance to supplier.
Okay, that's entirely the amount to the supplier, right?
No, so the bifurcation is just shown. So majorly it has two components. First is advance to supplier in tune of 5 CR, and second is advance tax in tune of, you can say, 3.2 CR. So these are two major components in short-term loans and advances.
Okay, understood. Thank you so much and all the very best.
Thank you, Karan.
Thank you. We'll take our next question from the line of Agam Shah, an individual investor. Please go ahead.
Thanks for the opportunity and congrats on good set of numbers.
You're not clearly audible, Agam.
Am I audible now?
Yes, please go ahead.
Yeah, congrats on good set of numbers. I have 2-3 questions. So first question, so if you can, I'm joining in the call for the first time, so pardon me. So if you can explain where does the moat or niche lie? So in terms of, let's say, if I'm a customer for your drone part, if I order from your website, I can see the same thing and, order it somewhere else and get it at a lower cost. So where is our niche or business lies in, getting in? So if you can broadly explain me that, is my first question.
Okay, well, I'll explain you this, but I'll just make it quick because we are on call and I just want to save time for others. So basically, Robo is as we say, electronic distribution company. And the way electronic distribution works is we are authorized channel partner for those suppliers. So to give you an example, maybe you see authorized dealer for Tata, something like that. We have authorized channel partner for more than 250 different vendors across world. And basically, the customers, when they want to buy these products, they buy through the authorized channel partners for 2-3 things. One is the authenticity, and second is when they buy from the authorized channel partner in a particular region, they get the support. Like the Indian customers can get better support for those products from a local Indian company. Now, when you say that where the moat lies, I think Robo's moat lies, we always say that we have 3 pillars of Robo. So one is our products. So Robo's moat lies in having all the products under one umbrella where we have around 20,000 products from different suppliers. So if you want to build a drone, you require 20-25 products. You're not looking to buy a motor. Generally, you are trying to build a drone. And then we have all the different products from multiple suppliers, which helps you to complete your project, which is building a drone. So this is our first pillar, which is products. Second is our IT infrastructure, which helps us to manage the inventory, efficient inventory of those 20,000 products. It's not just any inventory. It is what product at what price and what quantity we keep in stock. And that is a really complicated once it goes anywhere beyond 500,000 products. So maintaining these high number of SKUs, we have IT infrastructure which is ready to even maintain 100,000 or 150,000 products. And third is our service. So whenever you can check our Google reviews, which is 4.7 out of 5 and almost 5,000 reviews now on Google, which was around 4,000 last year. So what we do is providing refund replacement or solving technical queries of the product. These are not shoes, shirts, or where you buy, you like it, keep it, you don't like it, return it. So people need long-term warranties like 1 year warranty, 6 months warranty on this product. And also if the product is not fit for they want to know whether the product fits rightly in their project or something. So these are the moves for Robo.
Okay. And so also one more question. So in the presentation, you have said that out of total inventory, 3.68 inventory is very slow moving.
Yes.
So what do we do with this 3.68% of inventory which is slow moving or maybe is not moved or whatever? So is there any resale value for that or how is it?
Yeah, so just for the presentation sake of it, we have mentioned one part of our inventory management. Generally what we do is whenever we receive an inventory, we segregate it by, fresh inventory which is less than 3 months. After 3 months, it is tagged differently. We have to sell 40% of our inventory within 3 months. If not, then it is tagged as not moving inventory. We have to sell at least 60% of our inventory within 6 months. Then if it is not, then it is slow moving. We have to sell 80% of our inventory within 9 months. Otherwise, we'll tag it as very slow moving inventory. We have to sell all our inventory within 1 year, whatever we have bought 1 year ago. If not, then we'll call it a dead inventory. That does not mean we will not sell it, because if you see in every step, we are selling some of the products. And in every step, we do some action. So in 3 months, if we are not selling anything, we'll check if our listings are correct. Or by mistake, the product is not visible to customers on the website or something like that.
If the inventory is more than 1 year old, then you incur a loss on it or how is it?
No, it doesn't. It does not incur loss. It depends. If the product is only a little quantity remaining with us and it's a legacy product, we'll increase the cost. We'll get higher margins because we know that we have sold 10,000 of those. We can easily sell 50, 100 of those because customers are using in the systems and they'll require for maintenance purpose they'll require it. So we'll just keep it as it is and increase the price. Some of the inventory we will sell in on lower price. Maybe for some of the inventory, we have to incur a little bit loss, like, maybe 5% down price from our regular price, from our cost prices. So this is how we do it. However, you have to remember this is something that we have been doing from last 7-8 years. So whatever revenue and margins and everything you see, this is including everything, including this system of, slow moving products and removing them stage-wise. So that we have been doing already for last 7-8 years. So whatever margins and revenue we are maintaining, it is including this process. It's not that something that has popped up right now and will affect our future business.
And in terms of category, so will these categories keep on changing or how is it? The broad mix remains the same. So I believe drones and development boards are the leading ones. So will this continue to be leaders for next couple of years or this keeps on changing the categories?
It does not change over a period of year or two. In longer run, it will change because let's say 3-4 years ago, drone was very small business. Now drone has grown rapidly. Even the development board was very small business, let's say 7-8 years ago, but it has grown rapidly. Not rapidly, I'll say at a moderate stage. Now, if you ask me, maybe IoT and wireless is a small business for us right now, but it is been growing rapidly. 3D printer is been growing rapidly. So the technology, because this is electronic segment, the new technologies will come and some of them will grow rapidly, which gain some percentage in our chart. Some of them will grow moderate stage, then become stagnant, then slow down, and then so this will keep on happening. But not every year you'll see a change. Maybe today and 5 years down the line, you'll see some categories going up and down and some going out of the chart and coming in charts.
So how much people are there typically in R&D?
So right now we have 20-24 people.
20-24. Okay. And what is the working capital, net working capital?
Net working capital, can we answer this question?
In terms of days?
In terms of days. Almost you can approximately 90 days you can assume.
90 days?
Yes, 3 days. It's slightly less, but on paper side we can say 90 days.
90 days. Okay. And what will be the capex for next couple of years, 2 years? How much capex will be doing?
I don't we don't know, because we do not have any plan which is capex incentive, whether we want to build some manufacturing line and then to grow the business this much we need these many machines, something like that. So we have inventory projections because our business is mainly dependent on that. But such as capex machines or setting up own factory or something like that, we do not have the projections.
Okay. I'll join the queue. Thank you.
Yeah, thank you, Arun.
Thank you. We'll take our next question from the line of Pawan from Shade Capital. Please go ahead. Mr. Pawan, please use your handset mode.
Am I audible?
Yes.
Yes. But can you use your handset mode because there's some disturbance coming from your line? It is muffled.
Is it clear now?
Yes. Please go ahead.
Okay. Thank you. So my question is I think as I understood, 10% of your revenue is coming from in-house or partially in-house manufacturing. So can you give some sense what sort of margin difference between a manufactured product or maybe you're procuring from outside?
Roughly it is 8 to 10%. Higher market expand.
Okay. And any other advantage you see manufacturing in-house instead of procuring from outside? Some other color can you give on that?
Sorry, what? Could you repeat the question?
Yeah, my question is when you are manufacturing in-house, there might be certain other soft advantages also, maybe for a customer, maybe supplying faster or maybe a quality. Can you give some color on that?
Okay. So the two key advantages for our own product, Robo 2.0, is having our own brand, better control over competition, because since the product and the IP belongs to us, nobody can sell those products. Someone else cannot sell the product with the same brand. And second is having this higher margins. Now, if you want to understand in terms of timelines, we have a slight disadvantage, because if you want to manufacture product on your own, you'll require higher lead times. On advantage side, we can customize those products. So tomorrow when industrial customers will come for higher volumes and they will want certain modifications or customizations to be done, that we can do easily. Or if they come up with some custom requirement that, okay, instead of ABC product, I want ABCD product. So we can make that product, convert it to that particular thing. So I think that is the advantage part and disadvantage.
Okay. And can you give some roadmap, how you want to grow this? Right now it is at around 10% of revenue, by next year or maybe next 2 to 3 years. What sort of percentage of revenue can envision, manufacturing in-house? Something on that.
Yeah. So, as I said, it's just a child.
Sorry to interrupt. Mr. Pawan, can you mute your line when you're not speaking? Because there's some disturbance.
Sure.
Yeah.
Thank you.
So, as I was saying, these products, we believe these are babies. We're just getting started with this. And you don't want to tell your babies that तुमको engineer बनना है, doctor बनना है अभी से. They will get bogged down with that. So our plan is bottom up, where we identify the products or we identify the segments that where we feel that we will have a good leverage 5 or 10 years from right now. Then we try to manufacture those products or make those products in our own brand with some difference, launch them in the market and see how market is reacting to this. To the product where we get some traction, we'll double down on them. And for some products, we might not get good traction. So we'll just keep them going or maybe decide not to discontinue them. So we are aggressive on finding new products, putting more efforts in R&D and people, and our process as a robust DNA is such that we will not do anything which is not generating profit for us. So we want to generate some profit at bottom level for different products. When you go at the top, some of them will, who is having higher demands or the technology is growing, they'll grow in the market, and then collectively summing them up will generate us some revenue. So we are not right now thinking in terms of just increasing that 10% to some 20-30%. We'll know that will happen if we focus on the bottom line, making new products, selecting the segments right, and putting efforts and energy to grow those segments individually. Having said that, it's not the targetless kind of activity. We have our target set up for each and every product brand. For example, in SmartLX, we have a target of launching all the 200 products in coming 2 years, which is right now somewhere around 70-80. I believe that target will fulfill only in 2024, but those are small products like 500 to 2,000 rupees selling price per product. So we assign these targets to each product category or products, and we will know what next target to assign when we reach there.
Okay, so right now we don't have any like dedicated capex plan for that, but which I understood.
We don't require any dedicated capex funding for that. The only thing that these products require right now is a good team which can design, develop those products, to let them in the market, get customer feedback, and to develop more and more of those products. Some of the products which will require some molds, manufacturing, something like that, but that's in few lakhs. It's not a big capital, like nothing which I can say, 2 crore for this assembly line or 3 crore for this factory setup, nothing like that as of now.
Okay, thank you. Thank you for the detailed answer. Thank you.
Yeah.
Thank you. We'll take our next question from the line of Abhineet Kulkarni from Equity Ventures. Please go ahead.
Hello. Congratulations for a great set of numbers, and I hope I'm audible.
Yes, you are audible.
Okay. So my question is, for all the products that we are having, are there any particular products or regions where the suppliers have given us an exclusivity right?
Yes, there are a few suppliers which have given us exclusivity right for Indian region.
Okay.
So there are a few, but I'll not say like in 250 there will be some 20-30 suppliers.
Okay. Okay. And if you could tell me what percentage of the revenues would these products be?
I do not have that number handy right now, and it's a big, like there are 20-30 suppliers, so it will be really hard even to make a ballpark guess for that. However, I'll put an emphasis on that these are not the only arrangement that we do. So for some suppliers, we reach to a business level because I don't want exclusivity. Like sometimes I don't want exclusivity. Otherwise, the supplier will think that this particular products have a very big business in India, but maybe Robo is not doing the business. So as a purchase person, what I want generally is I want 2-3 distributors, but I want to drive 80% or more of the business so that I get the prices that nobody can beat in the market. I can have a good margins. And secondly, the supplier is also comfortable. He knows that I have 2-3 people, so even if sales goes down some year or so, he's not panicking. He knows that it is going down for everyone, and still Robo is driving 80% of my business. Is the main key player for us. So there are multiple dynamics to that. We cannot just look at this number and maybe come to certain conclusion. My personal preference is always to have leverage over suppliers by driving the revenue numbers high and being their top supplier in the region.
Understood, sir. Fair enough. Great answer. Thank you, and all the best for the future.
Thank you, Abhijit.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Ramadan Rane for closing comments. Over to you.
Thank you, Yashasvi. On behalf of FAME Securities Limited, I thank all the participants and the Macfos team for giving the time for this call. I would like to hand over the call back to Yashasri for the closing remarks.
Thank you. On behalf of Macfos Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.